Everybody says recessions come with opportunity and never waste a good crisis, but how do you invest your money during a recession? What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. You probably know of somebody who keeps talking about how they're investing their money in this economic situation and how they want to come out of this economic crisis a millionaire. Yup, I put all my money in airline stocks and then Warren Buffett sold all his airline stocks. Investing your money is tricky, but it can be even more tricky during a recession, which makes me wonder, do you know how to invest your money during a recession? Yeah, find a cheap company and buy it. Yeah, sort of. Just like how you should smash that thumbs up button in a good economy and a bad economy, you should be investing your money in a good economy and a bad economy. But when you're in a slow economy, that's when you really want to refine your investment strategy and make sure you're doing the right things, which is what we're going to be talking about today. So make sure you watch this video until the end because you don't want to miss any of these key details. And we also have an exclusive offer from our sponsor Stash that you don't want to miss. On the highest level of investing, you kind of have two general investing strategies. You have an active investing strategy, and then you have a passive investing strategy. And then under the active investing strategy and passive investing strategy, you have multiple different kinds of sub-strategies. Let's start by talking about active investing. Active investing is when you're going out spending time trying to find the best companies that are on sale. And then after you buy your investment, you're either going to have a strategy that's going to tell you to hold this investment forever, or you're going to hold this investment until you hit some sort of investment goal, like maybe a 50% return. Now, obviously, investing has risks, and you are never guaranteed to make money when you invest. You might even lose money, which is why you always want to do your own due diligence, and don't just blindly listen to your random cousin Bunty, or a random guy on YouTube, you know, this guy. If you want to do this active investing strategy, you need to dedicate at the very least a couple hours a week to your investment strategy. I mean, some people will dedicate pretty much their whole lives to the strategy, just reading company charts and stock charts and company fundamentals all day and night long. You don't need to dedicate your whole life to the stock market to find undervalued companies, but you do need to dedicate some time. That way you can find the right investments for the strategy. But before you jump into just researching companies and buying stocks, you need to clearly define your investment goals. Why are you making it so complicated, Jaspreet? My investment goal is to get rich. If your goal is slow and stable growth for the long term, then you can look at blue chip companies. These are your big and established companies that everybody knows the name of. Johnson & Johnson, McDonald's, Disney. Again, I'm not telling you what to buy, just giving you examples. The advantage of these type of blue chip stocks is that it's harder for these type of companies to just completely go away. And because of that, you're also going to see probably slower and steadier growth. So if you're trying to see quicker growth, then you might want to look into adding some growth stocks into your portfolio. Growth companies are your smaller startup type companies that usually don't have any profits because they're taking every extra dollar they have and reinvesting it back into their business. So you can kind of think of like Amazon 10 years ago or Starbucks before there was a Starbucks on every street corner. Just remember, bigger potential upside comes with more risk too. I mean, before Amazon, lots of people thought that eBay was going to be the next big online retailer. If your goal is to have passive income, then you should be looking for companies that have strong and healthy dividends, which are regular cash payments you get just for owning a certain company. And for this, you might want to consider looking into things like REITs, real estate investment trusts. So you could think of active investing kind of like trying to find the best companies and funds to invest in that are giving you the best deal. Passive investing, on the other hand, not to be confused with passive income, is a little bit different. Passive investing requires almost no upkeep on your end because you're just going to have a few funds or stocks that you want to invest in, and then every week or every month, you're just going to add more money into your portfolio, and that's it. By the way, these funds that I'm talking about, they're called ETFs. And you can think of an ETF or these funds kind of like a big group of companies. Now, instead of you trying to go out and find the best company to invest in, you can invest in a group of companies. So a couple examples of ETFs would be like VOO and SPY. These two funds will give you exposure to the top 500 companies in the S&P 500 or the top 500 companies in the stock market. There are ETFs out there for everything. Real estate companies, blue chip companies, growth companies, international companies, you name it. This is truly a passive investing strategy because once you know what 3 to 7 funds or companies you want to invest in, all you're going to do is keep funding your investments on a regular schedule. So maybe every Monday, you're going to add in another $100, or every month, you're going to add in another $2,000 into your investment portfolio. You're not trying to time the market now. Whether things are up or down, you're just going to keep following your schedule week after week and month after month and just keep making your investments for the long term. The easiest way for you to manage your money and your investments is to use a financial services app like our sponsor Stash, who wants to help you manage your money easily. Like if you're looking for an easy way to passively invest your money, Stash can do that for you. Just set your schedule, how much money you want to invest, and you're good to go. Plus, Stash lets you invest in fractional shares. So let's say you want to invest in Amazon stock, which might cost a couple $1,000s, but you don't want to put $2,000 into one stock. Well, with Stash, you can follow your schedule and invest as little as $1 a day or $5 a week buying these fractional shares, because Stash lets you invest with as little as just $1. That means instead of buying a whole share, you can just buy a piece of a share. But Stash is more than just an investing app, because they have a banking feature to help you manage your money and get paid up to 2 days early. Plus, if you use the Stash debit card to make your purchases, then you can get paid with stock back. That means if you go shopping at Walmart and you check out with your Stash debit card, then Stash will give you a little bit of Walmart stock at no additional cost to you. You can use Stash to manage your money and start investing for as little as just $1 a month. And right now, Stash is giving Minority Mindset fans $15 to start investing using our link in the description below. All you have to do is sign up for Stash using our link in the description below and then deposit $1 into your investment account, and then Stash will give you $15 to start investing. So if you want to learn more, you can use our link in the description below or go to stash.app and enter in our promo code JuneMindset. You've probably heard something along the lines of 90% of investors lose money. But have you ever wondered why? It's because most people invest on emotions, not financials. When people hear that a stock or an investment has been rallying, they get very excited. And that's when the media comes out and they say that this stock is unstoppable. And then people go and they look at the stock chart and they say, wow, this stock has pretty much gone straight up. And they think, if it keeps going up at this rate, I'll be rich in no time. This is one of the biggest mistakes that people make when it comes to investing. It's called the hot hand fallacy, because people think, wow, so I've been making so much money with this investment. That means it's more likely for this investment to keep going up. But the past performance of something doesn't predict its future performance. Eventually what happens is people who own the stock or investment early realize, wow, we're making so much money. Maybe we should take some of our profits off of the table. And this brings the investment down just a little bit, and then people get worried and they get panicky and then they start selling, which brings this investment down even more. Then if people realize that this investment was overvalued, then emotion kicks in and you start to see this panic sell and this investment comes crashing down. If you want to succeed as an investor, you need to remember, one, that you're in this for the long term, and two, you're in this for the long term. So if you're investing in a company that has good fundamentals and it has good profits and it has cash on hand and it's going to be needed in the future, and the price of this investment gets hurt, you shouldn't be panic selling, you should be panic buying. That's the interesting thing about economic slowdowns and crashes, is because strong companies are going to get hurt just because the overall market is hurt. Until this pandemic goes away, our economy is going to be, I don't know the perfect word, weird. States are opening back up in different phases. We're seeing an unprecedented amount of money being printed that is going to have long-term consequences on our economy. And to top it all off, we have a presidential election coming in November. That means you active investors are going to have to work extra hard to filter out all the emotion and continue to invest financially. And that also means that sometimes things are not going to make any sense. Hello everybody, we have breaking news. It looks like Bunty's clothing store is on the verge of bankruptcy, and their stock is up 20%. We've seen companies get completely shut down and then their stock barely moved because they got a whole bunch of help from the government and the Federal Reserve, aka free money. We've seen multiple times a horrible jobs report come out and then the stock market rally, and then we've seen other companies not get financial help and get pushed into bankruptcy. So there are a lot of wild cards out there, which is why it's even more important for you to pay attention to what's happening in the finance and business world. But if things don't make sense, don't get angry, just do what I do, eat some guacamole. And for you passive investors out there, the hardest thing for you is gonna be sticking with your strategy. Remember, if you are a passive investor, you are not trying to time the market or find hot deals. Your goal is just to stick with the strategy and keep investing investing money into your funds or your stocks week after week and month after month. That's it. If you are passively investing, you shouldn't even worry about the daily swings. The only time you should ever really consider panic selling is if a company you're invested in is seriously on the verge of bankruptcy. When a company goes bankrupt, there are a couple things you need to know. And I can tell you this because I am a licensed attorney. However, I am not your attorney. So if you have specific legal questions, talk to a legal professional in your area. First, you need to know what kind of bankruptcy this company is filing. If they file a Chapter 7, that means the company is done for and your investment has no chance of coming back. If they file a Chapter 11 bankruptcy, that means that your company is restructuring and there is a small chance that this company will come back. But right now, your shares are practically worthless. Second, you need to know what happens during this bankruptcy. When a company files for a Chapter 7, they are going out of business. So they're going to sell whatever asset they can because they are shutting their doors. In this case, a company is going to take whatever cash they can get from selling their stuff. So after selling their real estate and their desks and all their other assets, they're going to first have to pay off their debt holders, usually the banks. And then if there's anything left, which is almost always never, then they will pay this money to their shareholders. When a company files for a Chapter 11, they're trying to stay in business, but they're going to restructure their business. In this case, the company is going out making deals with banks and lenders, trying to see if they can get out of certain debts and seeing if they can raise cash from somewhere else. And during this stage, most of the time, your shares are going to be essentially worthless. And now if you're thinking, wait, but what if my company comes out of bankruptcy even stronger than before? Well, you still might not get any of the upside. Many times, if a company does come out of bankruptcy, they will issue new shares and a new stock, which would make your old stock worthless. When GM went bankrupt during the 2008 crash, you might have owned some of their stock. Well, a little time after going bankrupt, GM came back to life and they issued new GM shares. So the people that were holding the old GM shares were left with nothing, and now there's a new GM stock. Once in a while, you will have situations where people holding shares of a bankrupt company will get something, but I wouldn't count on that. When the 2008 crash happened, 41 public companies filed for bankruptcy. And by 2010, only 4 of those companies gave anything to their shareholders. The reason this is so important right now is because when we are in a recession or an economic slowdown, companies will go bankrupt. We've already seen it happen quite a few times. So when you're making your investments, you really want to factor in how much risk is involved, because higher risk comes with higher stakes now. Now, this doesn't mean you shouldn't take any risk or that you shouldn't invest your money. This means you need to know how much risk you're willing to take, know what your strategy is, apply it, and go for it. This is what financial education is all about. If you enjoyed this video, share it with one friend, that way we can help spread the word. If you want to learn more about how you can find a strong company to invest in on the stock market, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.